What a difference a week makes. Last week it was all doom and gloom, with the markets reflecting high nervousness around emerging markets, the US, Japan, and also the risks of the UK exiting the European Union, the so-called Brexit. And while Britain is still far from certain to stay in the Eurozone, with the political and international trade risks that presents, the recent good news came initially from China, who added further stimulus to their economy by again reducing the reserve ratio, down 50 basis points to 17%, thus freeing up roughly 700 billion yuan, or over 100 billion US dollars, in bank funds to be lent out. International markets welcome this announcement, pushing stock prices higher and also helping commodity markets to recover, including the price of oil. This has been followed with some slightly better numbers out of the USA, and then locally we cheered a higher than expected growth rate of 3% seen in the Australian GDP figures released on Thursday. Once again, no sign of a recession looming through these numbers, with household spending and solid housing activity adding to growth, offsetting the waning resources sector, and also compensating for the lack of planned non-mining investment ahead. So the Aussie dollar powered back to well above 73 cents, and our stock market is back above the 5,000 level. Happy days. But not so fast. Keep in mind this growth rate was for the end of last year, so is a lagging indicator. And the jobs and property markets are better leading indicators. And building approvals plunged 7.5% in January, down 15.5% year on year. What do we make of all this? Our view is that the Australian economy will maintain its below-trend growth in 2016, staying out of recession, but that offshore markets, both developed and emerging, are still highly vulnerable to any downturn. This is because, unlike Australia, they have very high levels of debt to GDP and a lack of monetary policy ammunition that would normally be available, with their interest rates zero or even negative. When markets gave a sigh of relief to the Chinese stimulus and pushed stocks and commodities back up, they gained confidence in the stimulus, not the underlying strength of the economy. And finally, international trade figures hot off the press show that our exports rose 1.1% in January and our imports fell a similar amount. The improvements appeared to come from the manufacturing exports, a pickup in the value of rural goods, and a fall in the cost of imported fuel, which is consistent with the welcome fall in energy costs, which in turn is helping businesses both large and small. Until next week, that's the market update from Bendigo Bank.